Hey everyone, I've been studying asset pricing for a few months and have surprisingly found a new result within the finite market model. I call it the Phi Lemma. Don't worry, my math professors and I are already in the process of getting our proof of the Phi Lemma published, so we're not like shooting ourselves in the foot by showing this on YouTube. I just wanted to do it because I'm like really excited about it. For those of you who don't know, I'm gonna quickly go over what the finite market model is. So we're all on the same speed, up to speed, and then we can go into the lesson proper and really talk about the Phi Lemma. Okay, so the finite market model, or FMM for short, is a financial model consisting of D risky assets, where D is some natural number, and one riskless asset. So that's D stocks and one bond, because we're thinking of stocks as the risky ones. Market participants buy and sell stocks at discrete times, 0, 1, 2, etc., up until some natural number, which we're going to call big T. The prices of these stocks are symbolized by the random variable S with superscript I and subscript T. So before I get a little bit more into that, I just want to point out, so there are finitely many prices. These stocks can only take on a finite number of prices. So finite prices, finite number of assets, finite amount of time, hence finite market model. All right, anyway. The superscript, which we're calling I, always refers to which asset we're looking at. And the subscript always refers to which point in time we're looking at. So for example, if I wrote S, superscript 2 and subscript 1, that is asset I equals 2 and time equals 1. When I equals 0, that's the bond, because there are D stocks. So we're starting the stock count at 1, stock 1, stock 2, stock 3, etc. And then the bond is just index 0 because that's the most convenient. If we leave out the subscript, which is the time, and we're only left with the superscript, which is I, the index of the asset, then what we have is a vector of that asset, the prices of that asset from time 0 all the way up until time t. Similarly, if we leave out the superscript and we have the subscript little t, then we're looking at the prices of all of the assets at time t. That's the vector. All right, cool. So a trading strategy, which I wrote as strategy here because I guess I'm lazy. Trading strategy symbolized by the Greek letter phi, Phi Lemma, that's why I called it that, is a sequence of real valued holdings of all assets 0 to D from time 0 to big T. Similar to the asset prices, the trading strategy has superscript I and subscript T, and they mean more or less the same thing, but it's not exactly the same. So again, with the superscript I, it's just looking at, if it's like phi with a 2 superscript, that's just what the holdings are for asset number 2. But for the subscript T, that refers to the holdings from time t minus 1 to time t. So that's including t minus 1 and excluding t. Now, why is that? Well, if we can only trade these assets from, at these discrete times, 0, 1, 2, and let's say big T equals 5, so 4 and 5, then we can only trade here, 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 and here, which means that in between, we're just holding it. We're holding however many we have. So that means that let's say we are talking about the holdings for asset number 2, and let's say it's time 1. What that means, according to our definition, is we're going from t minus 1, so that's 0, up until time 1. So it's what we have from 0 to 1, excluding 1. And we exclude it because, if we replace this 1 with a 2, then we're talking about the holdings of asset 2 from 1 to 2, and then from 2 to 3, etc. And obviously we can't have them overlap. And so that's why it's a little bit different. So the value of a trading strategy phi at time t is symbolized with and defined by the following function, which might look a little bit scary, but it's basically just a dot product. Any trading strategy is valued at whatever you can sell it for. And as a quick, really simple example, if there's just the bond and one stock, and at time, whatever it is, t, Let's say we have 2 bonds and 3 stocks, and the bonds will sell for 5 and the stocks will sell for 4. So we got 2 times 5 because we got 2 of the things that are worth 5. That's 10. And we got 3 of the things that are worth 4. So that's 12. So 10 times 12 is 22. So that's like the dot product of those 2 vectors. And I keep writing the vectors with like set notation. That's bad, but just pretend those look like vectors. Then that's what you can sell it for, $22. Yeah. All right. So that's all the notational stuff. The final thing I need to define, though, is an arbitrage opportunity, which is a situation in which market participants can construct a trading strategy that always does as good and sometimes does better than the bond. Now, that's kind of complicated to define mathematically unless we restrict the initial value of the trading strategy, which is why we're going to formally define an arbitrage opportunity in the following way. So an arbitrage opportunity is when there exists some trading strategy phi where these 3 things are true. So number 1, the initial value is 0. Number 2, the terminal value, or the value at time big T, no matter what outcome we're in, is always greater than or equal to 0. And so that's like the you can't lose part, right? Because if you start at value 0 and you never go lower than that, then you're good. And here's another really important part is the third property, which is that the expected terminal value, or what you expect to get at time big T, is greater than 0. So that's a risk-free chance for gain, which is like the more informal way of thinking about arbitrage opportunity. Now that we have that out of the way, we can get to the juicy part. Okay, so what is the Phi Lemma? Okay, let me just scroll to make sure it's all in view. Well, it refers to Phi Lemma nuts in your mouth.